Let me introduce myself. My name is Amanda Putri Gensti. Management Class 22 ANPM 22411 MT 14. Bookkeeping and recording are basic parts of accounting that focus on recording financial transactions of an entity, company, or individual. This material covers basic principles, recording methods, and organizing financial data so that it can be further processed for analysis and reporting purposes. The following is a complete explanation of bookkeeping and recording. 1. Understanding bookkeeping and recording. Bookkeeping is the process of systematically recording financial transactions to provide a comprehensive picture of an entity's financial position. Bookkeeping includes organizing daily financial transactions and ensuring all transaction data is recorded accurately and correctly. Recording is the process of documenting transaction data into books or accounting software, such as purchases, sales, payments, receipts, and other transactions. This process is the initial part of bookkeeping. 2. Purpose and importance of bookkeeping. Bookkeeping is very important because it forms the basis of financial reports and allows companies to know your financial position more accurately, track cash flow and manage finances better, prepare tax reports accurately, make more appropriate business decisions based on factual data, fulfill legal obligations and tax regulatory requirements. 3. Basic principles of bookkeeping. Some basic principles in bookkeeping that need to be understood include: consistency principle. Recording of financial transactions must be done consistently over time to produce accurate reports. Business entity principle. Business finances should be separated from the owner's personal finances. This means that business transactions and personal transactions should not be mixed. Historical principle. Historical cost. Transactions are recorded based on the original transaction value, not the current market value. Recognition principle. Revenue recognition principle. Revenue must be recorded when the transaction occurs, not when payment is received. Matching principle. Expenses or costs related to certain revenues must be recorded in the same period in which the revenues are recognized. 4. Recording methods in bookkeeping. There are two main methods of accounting records. Single entry method. Single entry. This is a simple method, generally used by small businesses or individuals. Each transaction is recorded only once. There are no debit and credit records. This method is suitable for businesses that are not too complex and only require basic reports. Double entry method. Every transaction is recorded in two accounts, debit and credit. The total debit value must be equal to the total credit value to maintain balance in the ledger. This method provides a more comprehensive and accurate picture of the company's financial position. This is a method commonly used in accounting because it follows basic accounting principles. 5. Basic processes in bookkeeping and recording. The basic process in bookkeeping and recording involves the following steps: storing and classifying source documents. Source documents such as invoices, receipts, checks, and other proof of transactions must be stored neatly. Each transaction must be classified according to its type, for example, income, expense, or asset. Identifying and analyzing transactions. Each transaction must be identified according to its type and transaction value. Transaction analysis includes identifying which accounts to debit and which to credit. Recording transactions in the journal. After identifying the transactions, the next step is to record the transactions in the journal. A journal is an initial recording book where transactions are recorded in chronological order. In the journal, transactions are recorded by stating the debit account and credit account. Posting to the ledger. Transactions that have been recorded in the journal are then transferred or posted to the ledger. Ledger is a collection of financial accounts that are used to group transactions by type, such as cash accounts, debt accounts, or sales accounts. Adjusting and closing the books. At the end of the accounting period, adjustments are made to reflect the actual financial condition. For example, recording unpaid expenses or income that has not been received. Preparing a trial balance. After posting transactions to the general ledger, the balance of each account is calculated and summarized in a trial balance to ensure that the total debits equal the total credits. Preparation of financial reports. Data from the trial balance is then used to create financial reports such as profit and loss statements, balance sheets, and cash flow reports. This financial report provides an overview of the company's financial performance and financial position.
My name is Amanda.